Hello and welcome to episode 405 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leeks. Damien, welcome back. How are you doing?
I'm good. I'm smiling as I'm talking to you, Andy, because I made a bold claim before we pressed record on this podcast that I would do this in one take. So Andy had limited editing because it's Friday. We've got a lot to do. I do feel it was a bold claim because you guys don't hear the obviously original version of the podcast and what Andy does, but the exciting bit of news is that soon we're going to be showing our podcasts on YouTube, so you'll be able to watch them. So we are going to start to record them and put them on YouTube. So we are going to have to limit the editing a bit. Otherwise, Andy will be forever and a day dealing with the podcast editing video and audio. So I'm going to have to be probably better, Andy, aren't I, and succinct to save you time. So that's why I'm laughing. But before we carry on with the podcast, I do want to read out a review from last week that we got. So terrific MTTM Podcast is the title of the review from Jill. And it says, I've been listening to Damien and Andy's podcast for a couple of years and I find them absolutely invaluable in demystifying the markets. They are insightful, accessible and also enjoyable. Both midweek markets and the general ones are essential listening whilst doing my workouts. And I've spread the word far and wide amongst my children and friends. Very well done, Damien and the team, and a huge thanks. So that made my day receiving that review. Now, this isn't about ego. It's just motivating for me and the team to receive the feedback from people because obviously we do this and don't see you. So it's really nice to have that back. And another one I'd want to quickly read out was from somebody who was studying professionally. And it said, I work in financial services and I studied the CISI PCIAM exam last year, which is basically an investment management exam. And it said, I listened to your podcast loads along with my study and your podcast was so helpful and was much better at explaining topics than the book, as well as providing lots of extra insightful information. It was a big stress reliever to my studying and happy to say I passed with a merit. So that was obviously great news and made my day. So those people, if they are your reviews, do write in damien@moneytothemasses.com and we will arrange for you to have a mug sent out.
Yeah, it's great to hear listener feedback. And actually, that reminds me of last week when someone got in touch. Actually, it was the person that we featured on the podcast last week got back in touch to say they had to basically stop their car because they realised that we were actually featuring their question and they were so excited they had to pull over the car and message some friends. And we've heard from plenty of people in the past that do things like go to the gym, do the ironing. And we were chatting about it in the office and we were fascinated. So we've decided we're going to post up on Insta stories on Sunday morning at 9 o'clock. It'll be there for 24 hours. And we're going to ask people what they're doing when they're listening to the podcast. So check out Money to the Masses on Instagram, on our Insta stories Sunday morning. Let us know what you're doing. Well, it'll be a bit of fun anyway.
And I don't mind if it's what you're doing then, even if it's boring, if it's just sitting there and you're just having a cup of coffee, I want to know. Or you can put in what you usually do. I'm just fascinated. I hear people do things like dog walking and whatever. I find it very interesting that people can do a workout while listening to us talk, Andy. I don't know how motivating that is for a workout, but let us know.
Yeah, I'm looking forward to seeing what we get. Okay, so let's move on to this week's podcast then. Damien, what have we got coming up on this week's show?
So I've got a pension piece this week. So it's about state pension and there is an important deadline coming. In fact, it's April, where there are people who could boost their state pension and you need to take action now. Otherwise, you're going to miss the opportunity to boost your state pension. So we're going to explain that. The next piece I'm going to do is something that's been inspired by talking the office and experiences. We're going to be talking about potholes and the damage caused to cars and how you can make claims against the authorities that should be maintaining the road. Now, in this office alone, we've all had experiences in the last few months. And if you drive anywhere, everybody's moaning about the potholes. And it's because of the weather and the lack of funding as well in terms of maintenance. So we're going to explain what your rights are and how you might be able to get money back for the damage that's been caused to your car by a pothole. And the final piece on the podcast, we're going to get Lauren on the show because there's been a development in the world of cashback. So we have cashback apps, we have cashback credit cards, but we do now have cashback bank accounts, so current accounts that give you cashback on your spending and your bills. But rather than be an isolated bank that's doing it, this has become something that's become more prevalent and competitive. And there's been a development in the market this week. So we're going to do a piece on it with Lauren, how you can earn money from your current account.
Great. So let's start with the pension piece. There's an important deadline coming up. We're going to explain how some people may actually be able to benefit from boosting their state pension. What have we got?
So Everything I'm going to say to you is summarised in an article on the Money to the Masses website, which you can find via the search function or in the show notes on your podcast app, or if you actually go to the podcast episode on the Money to the Masses website. But to explain what's happening, the new state pension, that came in on the 6th of April 2016, which means that most people under the age of 70 roughly are eligible for it. And the maximum amount that you can get as a state pension at the moment is £185.15 a week. That is going to increase to £203.85 a week from April 2023. Now, state pensions, you don't all get the same. The amount you get depends on the number of qualifying national insurance years you have. So for the rest of this podcast, you'll probably hear me say NI for national insurance. Now, what's important, a qualifying year is a year where you have paid NI contributions, and it has to be for a full tax year for it to qualify. Now, you'll usually need at least 10 qualifying years to get something and 35 full qualifying years of national insurance contributions to get the full new state pension. Now, the actual number of years you'll need is technically based on your age and national insurance records. So those who've started NI contributions before 2016 could ultimately need 40 national insurance years of contributions. And that's obviously down to legislation. So that could change in the future. So you may, or some people may, have to have more than 40 years of qualifying national insurance contributions. Now, of course, there comes a problem if you don't have enough qualifying years. And what can you do about that? Fortunately, you can plug gaps in your national insurance record, and you normally do that by paying money to remedy the situation. However, the rules are about to change in April, which will limit how far you can go back and plug up those gap years. So at the moment, you can pay for missing national insurance years going back as far as 2006. But from the 5th of April 2023, you will only be able to fill gaps going back 6 tax years. Now, that is why there's a sense of urgency, and you're going to hear more about this probably in the news, and you'll see headlines in the newspapers about it in the future. We're doing it now on the podcast because there are steps you need to go and take to check your national insurance record and then remedy the situation. So you're going to need time to do that. We're in February as I make this podcast. You've got until the end of the 5th of April 2023 to do something about it. Now, normally, I say normally, meaning before we had the new state pension, you could only go back as far as 6 years, which is what it's going to revert back to when it comes to plugging national insurance gaps. But there was a transition that happened because we moved into this new regime where they allowed this extended transitional arrangement. We could go back as far as 2006. So what I'm going to do now is explain how you can check whether you need to consider plugging the gaps in your national insurance record and how you go about it, but also whether it may or may not be worth doing so. So if you are a man born after the 5th of April 1951 or a woman born after the 5th of April 1953, then this is possibly relevant to you because those are the ages at which people would have or are due to reach state pension age under this new system. So the first thing you need to do is check how much of the full state pension you may get. Now, you can do this quite easily if you go to the government state pension forecast calculator. There is a link in the show notes. And what you need to do is you need to get a government gateway user ID. You can do all that there online. It's pretty easy to sign up. What you will get when you request your state pension forecast is you'll be told how much state pension you will get based on your national insurance record to date. And you'll also be told how much state pension you're likely to get if you work up to your state pension age. So it is personalised to you. In the article that I mentioned that's on the Money to the Masses website, you can go and have a look. There's an example of one on there so you can see what it looks like. Now, if you're not predicted to get the full amount of £185.15 a week, and I say that's increasing to £203.85 in April, then you need to check for gaps in your NI record. And there is a link in your forecast when you've received it to click on to view your national insurance record. If you have gaps in your national insurance record, then it is possible that you can plug the gaps for free with national insurance credit. So you don't necessarily have to pay. And there are a series of scenarios that may apply to you that mean that you can manually request a credit to your national insurance record to plug any gaps. You can apply for national insurance credits to be manually added to your record if you have been unemployed but you were actively seeking employment during the period, you were receiving statutory sick pay, you were receiving employment and support allowance, you were caring for a family member. So that can include something that's often referred to as grandparent credit. So the family member must not be your child and must have been under 12 at the time that you had the gap. So that is why you can have grandparents who may have been helping out in terms of childcare while the parent maybe had been working. They could technically plug gaps. A lot of people don't know about that. Caring for a sick or disabled person is another one. There are full details and caveats on each of these in the article. You could have been a foster carer, you could have been receiving statutory maternity pay or paternity pay, you could have been on statutory adoption leave, jury service, you could have been wrongly imprisoned. That's an interesting one where you can actually get national insurance credit. You could be a spouse of a member of the armed forces where you went overseas because of a posting, or you could have attended a government approved training scheme. So there are various ways where you could get the gaps in your national insurance record plugged, therefore boosting your state pension without you having to pay anything. But of course, you may have other gaps in your record, or they might not apply to you, in which case you would need to pay to have those gaps plugged. We'll come on to the numbers in a minute. But one thing to point out, if you have part years in your national insurance record, they don't count towards a qualifying year. So it may be that therefore you top up for the rest of that year, which would actually make the top up a little bit cheaper. So now if you think about working out whether it's worth paying to boost your pension, if you are near state pension age, you're more likely to benefit from topping up your national insurance record. And it's relatively easy to work out whether topping up is worth it. Essentially, if your state pension is forecast to be less than the £185.15 a week, and you can't manually plug those gaps for free, then topping up is likely to be worth it. But if you are younger, perhaps you're in your 40s, for example, then you'll have to work out the numbers to see whether you will naturally, throughout your working life, accrue enough qualifying years anyway to mean that it might not be as worthwhile plugging any gaps that you might have. But that's going to be a personal decision, because obviously you're going to have to make an assumption about whether you will accrue more qualifying years right up until your state pension age. So if I jump to doing some numbers, it costs £824 to buy a full national insurance year, and that can add up to £275 each year to the new state pension, and that's before you are taxed. Don't forget, state pensions are taxable. So you'll need to live at least 3 years after getting to your state pension age to make paying for a full national insurance year worthwhile. Bear in mind that you can buy a full national insurance year for less if you're self-employed, or if you're topping up a partial year, as I've already mentioned. One thing to point out is that you can't top up your record so that you'd earn more than the £185.15 a week. So bear that in mind. Now, thinking about the potential gains, if, for example, you bought 10 years worth of national insurance qualifying years, you'd break even after 3 years, and if you were to survive an additional 10 years, that would mean you'd be almost £20,000 better off. So there is that dynamic about longevity, how long you're going to live, versus what you pay now to boost your state pension. Now, the other thing to just throw out there is that the state pension age is expected to rise to 67 by 2028 at the latest, and 68 by 2037, although there are constantly rumours surfacing that that might be brought forward. And if you're trying to work out longevity, the average life expectancy of a woman in the UK is around 87, and it's 84 for a man. So obviously this piece is about paying national insurance contributions or claiming qualifying years to boost your state pension before April 2023. We're not talking about increasing your state pension by deferring or anything like that. It's a slightly different topic. The only way to be sure whether you're likely to benefit from filling the gaps in your national insurance record is to seek advice. Now, if you're already claiming your state pension or you've deferred it, then you should speak to the pension service, and we've put a link in the notes of this podcast that people can go through to. And if you've not yet claimed your state pension, so you've not reached state pension age, then you need to speak to the Future Pension Centre. And again, there is a link in the show notes. So if nothing else, I'd love the idea that everybody who listens to this podcast has gone and looked at their state pension forecast. And you have done it, Andy, and I have done it. And it is one of the stages in the Money to Masses Money MOT. So that's how important it is to do it.
Okay, so let's move on to the next piece then. We're going to be talking about potholes. We're all seemingly having problems with potholes at the moment. The weather has been disastrous, and we're hearing lots and lots of stories about people having to change tyres. But there is something people can do, then you're going to explain how this sort of ties in with money.
So with the cost of living crisis, there's obviously been conversations in the office and with friends and family where it seems a lot of people have been having to fork out for new tyres on their cars or damage that's been caused by potholes in the road. And with the weather that we've had, there's been increasing numbers of potholes and with the authorities digging up roads, etc. So the problem is the cost of tyres, and there's a tip that Andy's going to come on to actually separate to what I'm doing here about how you can get tyres more cheaply. But the cost of tyres is extortionate, and therefore if there's any way that you can claim back money, then I think it is particularly relevant in the current climate. So what are the rules around potholes and being able to claim back for any damage that's been done by them? Now, if your car, bike or motorbike has been damaged by a pothole in the road, then you can make a claim for the cost of repairs, but only if the authority for maintaining the road was at fault. If they are, then you can get back all or part of the cost of those repairs. And if you believe what you see online, anecdotally, people have claimed to have got back hundreds of pounds from claims that they put through to the relevant authorities, and I'll explain who those authorities are in a second. But also there have been instances where people have been able to make claims for personal injury from an accident that's been caused by something like a pothole in the road. Now, there is no specific law covering claims for potholes, but authorities do have a legal obligation to keep roads safe under various legislation, which includes having to fill potholes. It therefore means that the authorities have an obligation to pay out for damage caused by the defects that they should have maintained. Now, there seems to be a get-out clause, if you look around the subject, that crops up that if a pothole hasn't been reported, the authority doesn't have to pay up. It seems a bit of a grey area, that one. So it's important that if you hit a pothole or you see a pothole and you don't even hit it, that you should report it to the local authorities to keep not only roads safe and in good conditions, but it could help other people in the event of a claim. Most authorities with responsibility for maintaining roads do have a relatively easy way of reporting these potholes on their websites. Now, the confusion lies as to who you report the problem to, because different authorities are responsible for maintaining different types of road. Broadly speaking, in England, Scotland and Wales, local B roads are maintained by the council. So any potholes relating to those roads should be reported to your local council, and you normally can find an area to report them on the website for that council. When it comes to major A roads and motorways, that's Highways England, so you have to report the pothole to them. And when I say report, that also is where you're going to have to make a claim. For Greater London Red routes, it's Transport for London. Now in Scotland, it's a little bit more simple. The motorways and A roads is Traffic Scotland. In Northern Ireland, all road types are DFL roads. And you can search for information about each of those, about where you submit reports. The other place I would also use is fixmystreet.com. Certainly in the area that I live, lots of people report potholes on that website, and the local council monitors those websites. It's not just about potholes, it's about anything that's wrong in the local area. It could be about litter, it could be about graffiti, it could be about fly tipping, and they report those issues, and the council uses that, responds, and then reports when they fix the issue. You can also report, therefore, potholes on there, and I've looked in the local area near me, and you can see potholes that have been reported and if they've been fixed and when. Now, I will say that it doesn't cover every area as well, because I know, Andy, you mentioned when we talked about this that it doesn't seem to be being used in your area, but do have a look at that fixmystreet.com. And it is a place that the RAC themselves refer people to go and put reports on as well. Now, the benefit is that that can provide some evidence for you about a pothole that hasn't been fixed but has been reported. So when it comes to making a claim, you would normally be able to make a claim via the form that you may have submitted, or the route, it could be an email, that you submitted the report of the pothole to the relevant authority. In an ideal world, you could be able to make the claim at the same time and then they would review it. So when it comes to claims, you must prove that the damage was specifically caused by the pothole. So that means that it needs to be deep enough to be considered a hazard, and generally that is a depth of at least 40 millimeters. Now, I have visions of people going out there with rulers almost getting run over to measure the size of the pothole that they've hit, but it is evidence. If you do hit a pothole, then the evidence you probably need to gather is the things like photographs, not only of the damage to your car, but the pothole itself, the location, where it is on a map, anything to show that it actually was the cause of the damage to your car. Obviously, you need to be safe when you're doing it. The other thing you can do is get a mechanic who is fixing the car to put in writing that, it was caused by a pothole, and the mechanic can tell you that. Now, when you have all of that evidence and you put it in with your claim, then you may get the claim paid out, you may not, you may get part of it paid out. Now, you do have another option if you want to continue to pursue this, is that you can put in a freedom of information request to prove that the relevant authority wasn't maintaining the road in accordance with its own guidelines. The issue is that different councils, for example, have different guidelines. So you need to get a freedom of information request that asks for the inspection logs on that particular road, how the authority has maintained that road that damaged your car, and its policy for inspecting it. Then that can add weight to your claim, which you can then put in, and it might increase your chances of actually getting money paid out. If you don't succeed, then you're going on to the small claims court. But the message of this part of the podcast is that if you do hit a pothole, then you may be able to claim back at least some of the money for the damage that's been caused, and it's worth pursuing because it's not going to cost you anything to do. But just to finish this piece off quickly, when it comes to saving money, Andy mentioned in the office something that none of the rest of us had ever heard of. So when I've had to replace a tyre, I've ended up having to look in the handbook of my car, trying to work out which tyre my car needs, then ring around a host of garages trying to find out if they've got a tyre and what the cheapest tyre I can get, etc. And it ends up being quite a long-winded process in order to get that tyre fixed if I want to get it done at a reasonable price. And Andy came up with what he actually does in order to save money and time.
Yeah, that's it. I use a website called blackcircles.com. And what that is that's a website where you can put your registration in and your address, and it will know from your number plate exactly what tyres your vehicle needs. It will then go ahead and search all of the different tyres and specs for your vehicle and give you the best possible price. But crucially, and this is where I think it's quite clever, it will actually search all the different garages in your area and actually has access to their calendars. So we'll be able to give you a time and a price on when it can be booked in and sorted. And that is literally it, all in one place. So you can actually get a replacement tyre, you know how much you're paying, where it's going to be done, all in about 5 minutes.
And what I loved about it is that you can see the choice of tyres, so you can then pick what suits your budget. But this was a service that your garage actually told you about, wasn't it, Andy?
Yeah, crucially, you're not going to be undercutting your local garage potentially by doing this. The likelihood is your local garage is already signed up to this. So this is just something that will help speed up that process, and you'll still be supporting your local garage potentially. So yeah, definitely check it out. Okay, so let's bring Lauren onto the podcast then. And before we get into the piece that we're going to be doing on this week's pod, Lauren, I suppose firstly, we've got to cover off what we've just been chatting about. Now, tyres and potholes, tell us your pain.
Yes, so happy 2023 to me. I had £380 bill for 2 new tyres. Car went in for a service and I ended up with 2 puncture holes in my tyre. So yeah, me and cars don't go very well. So I will be listening back to this podcast piece and hopefully trying to claim back £380 for the tyres that I spent this year.
No, definitely make sure you do that. And I'll be doing the same because I've also had to replace a tyre this year after having a bulge in my tyre, which I was told by the garage was definitely caused by a pothole. So I'll definitely be doing that. Right, let's move on to what we're talking about this week. And we're going to be talking about cashback. Now, we've talked about cashback in the past. We've particularly focused on cashback credit cards. We've also looked at cashback apps. But this week, we're going to be focusing on cashback bank accounts, specifically current accounts, because there's been a new wave of competition with lots of banks coming out with a number of offers for both new and existing customers, which can gain anything from 1 to 5% cashback on various purchases. So Lauren, a particular bank has come out with something this week and it inspired this piece. So what has happened?
Yeah, so on Thursday this week, Chase Bank announced that they were going to be extending the 1% cashback offer for existing customers. So at present, if you open a Chase Bank account, you can get 1% cashback for 12 months. So from April 2023, existing customers can have their 1% cashback offer extended by another 12 months. Although this does come with new terms and conditions, such as a minimum pay-in of £500 a month, and the cashback will actually be capped at £15 a month. So if you haven't yet opened a Chase Bank current account and want to benefit from the cashback offer, you can do so as a new customer and you won't have to adhere to the minimum £500 a month pay-in. Although if you open a Chase Bank current account from the 1st of May, you will have your cashback amount capped at £15 a month. So if that is something you're interested in, I would suggest that you look into opening that as soon as possible.
Okay, so the goalposts are moving on that particular offer, because I have to be honest, we couldn't move for the last year. When talking about cashback, for people sort of highlighting Chase Bank, it was new to the UK market. It's an American bank that's come over with this really enticing 1% cashback on all purchases on debit card. I say all purchases, there are some exclusions in there. I think gambling, cryptocurrencies, those kind of things. But essentially, you'll get 1% cashback on all of your spending through your debit card, and people loved it. But of course, back then, it was always only going to be for 12 months. So it begged the question, what was going to happen after 12 months? Well, we now know. You've gone through some of the terms and conditions there. The good news is for most that they are extending that. So existing customers that had this nice cashback offer are going to continue to get it. But as you said, it's going to be capped going forward. And we kind of had a feeling that this was going to happen, because when we reviewed Chase Bank account, we did highlight a few of the shortcomings, if you like. The fact that you can't have joint account holders on it, you can't have an overdraft. And so we were wondering, is this ever going to be an actual bank account that people could actually use as their bank account? Well, obviously, they've come to the UK market. They're keen to get people on board. And so that's why seemingly they're introducing slowly but surely this £500 a month, for example, deposits for existing customers. So they're clearly looking to make sure that people are going to be using this as their current account bank, their main bank of choice. But it was only a couple of months ago that we also reported on other banks that were bringing out some really competitive cashback rates on their current. So why don't we go through a couple of different options that people consider for cashback through their current account? Because let's say they might be going for a mortgage, they're worried about credit checks, they don't want to take out another credit card. This is a viable option for them. What else is there?
Yeah, so the one thing that is quite good about these cashback current accounts is they allow you to earn cashback on a lot of the spending that you would be doing anyway. So for example, Nationwide, they have recently introduced a 5% cashback offer on eligible supermarket spending. This is capped at £10 a month, but that is something that you would be doing anyway. So why not maximise your money and earn cashback on something that you would be spending every single month? Now, the offer with Nationwide is only valid until the 30th of April 2023, and you do need to have a Nationwide Flex Direct, Flex Plus, Flex account or a Flex Student current account. But if you aren't an existing customer, you can open one and still benefit from the cashback offer.
Do you know what I quite like about that is they say that the offer is only valid until the 30th of April, but we know, for example, from Chase, they said their offer was only for 12 months. They've since come out and extended it. So there's nothing to say that once people are enjoying those benefits, that they may extend it. Obviously, we don't know what's going to happen, but take advantage while they're offering it. Okay, so what else is there?
So Santander actually offers two cashback current accounts. You can have the 123 current account, which allows you to earn up to 3% cashback, or you can have the Santander Edge current account, which allows you to earn up to 1% cashback on household bills or 1% cashback on essential spending. Now, both of these are capped at £10 a month with the Santander Edge current account, and there are some limits that you also need to be aware of, such as monthly account fees and minimum deposits. And so finally, NatWest and Halifax also allow you to earn cashback with their reward current accounts. You can earn up to £5 a month, but there are minimum deposit amounts and T's and C's that you need to be aware of that you will need to meet in order to qualify for the cashback.
And so all of the details that Lauren read out there, they are going to be available on an article which we've done on the website. We will link to that in the show notes as always. And just finally on that, I just wanted to mention that there are other banks that also do cashback offers, but don't necessarily highlight it as well as they could do. For example, I'm going to call them out. Lloyds offers what they call everyday offers through their mobile app. And I just checked actually, I've made £98 in cashback over the last couple of years. And I mentioned that to a couple of people in the office who actually had a Lloyds bank account, wasn't their main account, but did have it and has the app, and they had absolutely no idea. So make sure if you've got a banking app that you do check to see if there are any cashback offers within that app anyway, because banks aren't always the best at advertising those offers.
Yeah, and on that, Andy, as well, even if you go in there and look, if you have got them, sometimes you do have to opt in. So you may have to go into the settings and opt in to be able to get these rewards, which is a little bit sneaky. You don't get them automatically.
So we've covered a few different ways to get cashback, even just through a normal current account, instead of having to, let's say, take out credit through a credit card or downloading a separate cashback app. I suppose finally, we could just quickly mention there is another way you can earn money through your current account, and that's by switching. How does it work, Lauren?
Yeah, so NatWest, the reward current account, at the moment you can actually get up to £200 for switching over using the current account switching service. So this is where you switch your current bank account over to another bank account. So that does mean that you do have to switch over all of your direct debits and your salary into that account.
Yeah, and so that's a great way to be able to make a little bit of extra money if you're in the market for a new bank account. But obviously do bear in mind that if you've only got, say, the one bank account and it's a long-standing bank account and you're thinking about potential credit in the future, think carefully before you do that, because actually having a long-standing relationship with a bank is a positive for your credit report. And actually by using the current account switching service, that actually will close down your old bank account as well. So just bear that in mind. But if that's not an issue for you, then great, because the current account switching service does a lot of that legwork for you. So it will change over all your direct debits, for example, and it'll also communicate with your employer and to make sure that your salary is paid into the correct bank accounts, which is good.
Yeah, and again, if you want to find out some of the best current account switching offers at the moment, head over to the Money to Masses website, where I've recently updated an article which has all of the latest switching offers over there for you.
Great, thanks for that, Lauren. Right, Damien, let's bring you back in.
Yeah, that's it. We're done. So as ever, please do leave a review for the podcast. You heard how happy it makes us and how motivating it is for the team. You can do that on whatever app that you use. Don't forget to join the Facebook group, facebook.com/groups/money to the masses. But also go on Instagram this Sunday and Monday and tell us what you're doing or where you are when you listen to the Money to the Masses podcast, because we are fascinated by this and we're going to share some of the results anonymously as well.
So that's it. We're done for this week. Until next time.
Until next time.